In order to realize the right to housing, the right to food, the right to education, the right to health, countries need to mobilize resources in order to finance public services and social protection. And so they need to increase the revenue they obtain from taxing both households and corporations. And their ability to do so is therefore extremely important to preserve and strengthen in order to allow the full realization of human rights.
But every year, governments around the world lose over $300 billion to abusive tax practices by multinational corporations. This lost revenue has devastating impacts on human rights outcomes.
The International Covenant on Economic, Social and Cultural Rights requires states to mobilize resources in order to realize human rights. And the Covenant speaks of using the maximum available resources to do this, which means basically that the wealth available in the country should be dedicated primarily to fulfilling the rights to housing, health, education, food, for example.
If there is more revenue generated, then that means there's more money to go around in terms of investing in actually the services that we need. We'll be able to have better quality of education, we'll be able to have better social protection services, we'll be able to have better healthcare, but not only in terms of institution, but also servicing the people who contribute to this sectors. So we'll have more doctors, we'll have more nurses, we'll have more children and girls going to school. And so that also contributing to the output of the economy. So we will actually have labor to be able to service the economy, but with good quality services.
The United Nations Guiding Principles on Business and Human Rights were adopted unanimously by the Human Rights Council in 2011. They represent the definitive international standard on human rights compliant conduct on the part of business entities and make it clear that private companies are subject to human rights responsibilities. While the UNGPs don't explicitly talk about tax abuse, in the years since they were adopted, the UN human rights system has recognized just how fundamental tax policies are to human rights outcomes.
You not only need to protect human rights, but actually make sure people can enjoy the rights. And so states, multilateral institutions should make resources available for the fulfillment of human rights. So this definitely connects to the business and human rights agenda, because the guiding principles say, every right should be respected in the context of business activities. This means that human rights should be fulfilled.
The Committee on Economic, Social and Cultural Rights adopted in 2017 a very important general comment, an authoritative interpretation of the International Covenant on Economic, Social and Cultural Rights, which is General Comment number 24, on the issue of how the International Covenant on Economic, Social and Cultural Rights should be taken into account in regulating business enterprises. And one paragraph of that general comment relates to how businesses should be taxed in order to support the human rights agenda. And the basic lesson is that countries should cooperate with one another in order to counteract the fiscal competition that is the result of economic globalization. And this fiscal competition, this tax competition between countries, is one in which countries resort to beggar-thy-neighbor policies, lowering the corporate income taxes in order to attract investment.
International human rights law also makes it clear that states' human rights obligations don't end at their national borders. This has major implications for both governments and business entities, as decisions taken by business actors in one country can have a huge impact on human rights outcomes in another. Let's pay a visit to two countries which have been vocal champions of the business and human rights agenda, Kenya and Ireland, to see how tax justice was addressed or not addressed in their implementation of the guiding principles.
So national action plans are the government's guiding plan basically for business and human rights. They are a policy document. They set out how governments are going to achieve certain targets.
One of the things that is missing from the business and human rights agenda globally is obviously the issue of taxation and how that should be included in it. And I firmly believe that that is a missing element of it, particularly so in an Irish context, for all the reasons that we're familiar with. The positioning of multinationals headquarters in Ireland, the role of Ireland as a global tax haven, make the issue of taxation in a business and human rights context absolutely essential.
Irish civil society pushed hard for taxation to be included in the National Action Plan on Business and Human Rights, but these demands were ignored. 7,000 kilometers away in Kenya, however, much deeper consultations on the development of the country's NAP led to tax justice and revenue transparency becoming a key element of the plan.
The National Action Plan for Kenya, it's a 5-year plan, and there are quite a number of institutions, both state and non-state actors. And when we say non-state actors, we have local institutions, we have international institutions, that is international non-governmental institutions, national government non-governmental institutions, including also community-based or grassroots level institutions.
There was also the appreciation during the NAP development exercise or process that revenue is a critical thing for the country because it drives many things, and it is important that it is pursued in a manner that is transparent and that facilitates accountability. So questions around disclosure, questions around information were very and still remain very critical.
When governments don't invest in those public services, a lot of the burden is bared by a lot of women, and also young women who have to drop out of school to be able to contribute to care services in the home, taking care of parents, elder care, child care, all those services which are privatized or not even financed at all, create a barrier to women exercising their economic rights.
Countries' ability to tax multinational corporations is also constrained by international pressures, especially bilateral tax treaties and multilateral agreements with other countries. Kenya was one of 4 countries that refused to sign up to the Organization for Economic Cooperation and Development's Global Tax Agreement, which would have required it to give up its tax on digital services.
It's less of a problem of how they're taxed. It's more of a problem how they're not taxed. And I think when we saw with the OECD deal, you started off with this ambition, and then it was whittled down, and then it was even more whittled down with so many carve-outs.
Ireland played a key role in that whittling down of the ambition of the OECD deal. According to international human rights law, countries should cooperate in good faith in international negotiations to ensure all countries can collect their fair share of taxation from multinational companies. Ireland's National Action Plan on Business and Human Rights ignored the issue of corporate taxation, however. International negotiations on a new framework convention to tackle international tax abuse are now underway at the United Nations, but Ireland has emerged as one of the countries seeking to impede this initiative too.
The move to take tax from the OECD to the UN then is really important because it, at least notionally, everybody has a say. And it was really disappointing just to see the vote on the African group's leadership on this. It was great to see it pass, but it was really disappointing to see Ireland, one of a small number of states, trying to vote against it.
Ireland's facilitation of cross-border tax abuse is also underpinned by a vast network of double tax agreements. DTAs are bilateral agreements between 2 countries designed to prevent companies being taxed twice on the same revenue. All too often, however, they create loopholes that companies can use to avoid paying their fair share.
There has been a serious challenge in how we approach DTA negotiations. If you look at a case example like Kenya, and you look at the unit that is responsible for the negotiations of DTAs, which is housed within Treasury, our Treasury, you will realize that whenever they are entering into negotiations with financial centers and countries outside, especially in the global north, you will find dedicated teams from the global north. You will find long years of experience within those that are from the global north. You will find that as the global north countries are approaching Kenya, they'll come with a raft of requirements and preconditions. The negotiations have been approached with a mindset of we are open for business, we want to attract more FDI. We might be negotiating a DTA that actually takes away our taxing rights. I know that very well. Digital companies today like domiciling themselves in a place like Ireland.
On double taxation agreements, we have done research on different examples of the deals that have been struck between the Irish government and other countries in the global south, and the general attitude that has been taken has, in our view, been overly adversarial. It has come from this position of trying to drive down withholding taxes, for example, and strike as advantageous a deal as possible for Irish companies and Irish revenue authorities.
And Kenya, despite being one of the countries pushing for a fairer international tax system, still has a lot of work to do if it is to bring its taxation regime into line with its human rights commitments. Crucially, the National Action Plan on Business and Human Rights only addresses international tax issues and fails to address the fiscal policy mix at domestic level. And when corporations aren't paying their fair share, the burden of taxation gets shifted onto the shoulders of those least able to afford it.
We have the proliferation of special economic zones across the country. The companies that are involved in either producing for export in those areas have been doing this for years. They will get tax holidays, for example, for 10 years. And then on the 10th year, they are going to metamorphosize and become a new entity and continue doing business and enjoying a new raft of tax holidays.
And so what happens is that, especially with the huge debt burden that we've been having, is that a lot of the government policies are taking, regressive tax measures. And that highly affects women and girls, because you look at the cost of living has gone high, even if you look at the terms of taxing consumables. Also in relation to also accessing, of course, fuel costs. A huge chunk of the women in the region, apart from the urban areas, are still using fuel, kerosene, to be able to cook, and so this affects them.
Until women are on the table of treasury, until they are there, bringing their differential thinking and creating a balance, it's the only way. When we bring all the perspectives of men, women, youth, rural people versus urban folk, pastoralists versus farmers, then we will get a balance. But for now, like I said, even our thinking of how we manage the economy is patriarchal.
Of course, the United Nations Guiding Principles are not only about the state's human rights obligations, but also, crucially, corporations' duty to respect human rights. A corporation committed to bringing its tax practices into line with human rights would need to be paying the right amount of tax in each jurisdiction where it operates, ensuring that its contribution to tax revenue corresponds to where its profits are actually generated. It would also need to do this transparently. The Fair Tax Mark is an accreditation provided to companies that conduct their tax affairs in precisely this manner.
So there's really three things that we're looking for in the tax policy that says to us that it is a meaningful tax policy. Number one, we're looking for a commitment to the spirit of the law as well as the letter of the law. Number two, we are looking to see that there is a commitment to not indulge in profit shifting, i.e. you are posting profits in the country where the economic value is added. And number three, we want a commitment to that there's no artificial presence in tax havens.
This means providing real transparency on their tax affairs in each and every jurisdiction in which they operate.
So one of the big asks of the tax justice movement across the world is that business, multinational enterprises, should produce a country-by-country breakdown of their income, profits and taxes in each country. Only then can stakeholders actually get to see whether profit shifting is taking place.
Another key facet of this commitment to transparency is that companies should avoid secrecy about who is really in charge or benefiting from their activities. In line with the UN guiding principles, the fair tax mark also calls for these responsibilities to be embedded and formalized at the board level. Where the guiding principles arguably go further than the fair tax mark is in their requirement for thorough human rights due diligence on supply chains. In the case of abusive tax practices, such due diligence should be extended to, for example, accountancy firms that facilitate cross-border tax abuse.
To understand who they are buying from, identify potential human rights impacts from the operation of, this commercial partner, have a full picture of the potential risks, the actual harms that have already happened, in case they have happened, how they have been addressed, what are the mechanisms in place to address potential future harms, etc.
Since the UNGPs were agreed in 2011, the links between responsible tax conduct and human rights outcomes have been rising up the international development agenda as well.
2015 was a major turning point in this global discussion about taxation and businesses. In July 2015, the Financing for Development Summit was held in Addis Ababa, and that led to the agenda action of Addis Ababa being adopted. And in September 2015, the Sustainable Development Goals were announced to shape the global agenda for the years 2015-2030. And both these documents led governments to affirm the need to strengthen cooperation between countries in order to enhance their ability to tax economic activity taking place under their jurisdiction.
There has been major concerns, for example, with several multinationals that have been working out of Kenya, deriving massive profits out of Kenya, paying very little tax for the profits that they make. But even as they pay little tax, their adherence to the best human rights standards has also been wanting.
States should cooperate with one another in order to ensure that they can tax businesses more effectively in order to mobilize resources for the fulfillment of human rights. That is currently not frequently part of the business and human rights action plans that countries have adopted, but it should be increasingly visible in those plans, and it is certainly part of what governments should do in order to ensure that the economy works for everyone.